Welcome to today's webinar on manufacturing conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of this presentation, so if you have a question, please type it in the chat box on Zoom. We'd also love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
All right. Thank you, Haley, and thanks to everybody who is participating this morning and watching our webinar online. I'll be presenting the results of an annual survey of manufacturers in the Ninth District. For those of you who have watched our recs in the past, you might be familiar with this survey because we've presented on it via this forum several years in a row in our regional economic conditions webinars. Before I go any further, I just want to share my usual disclaimer that my opinions are my own, and I'm speaking for myself and not necessarily for the Federal Reserve Bank of Minneapolis or the Federal Reserve System. Having said that, I'll try and keep my opinions out of it, maybe until the Q&A portion, and even then I'll try and keep my opinions to a minimum and just keep things based on the facts and particularly the findings of this survey. So briefly, here's what I'll be presenting before we get to a few minutes of Q&A at the end of our 30 minutes this morning. I'll be talking a little bit about an overview of the manufacturing sector and just its size and its role in the Ninth District, just to kind of level set exactly how important this sector is in our region before I get into the survey results. So as not to keep you in suspense, I'll just give you the kind of elevator pitch summary of the survey results. We found that manufacturing activity contracted, or that is 2024, fairly substantially for the second year in a row, and you'll be able to see what those results look like in a moment. And that was across most business indicators. But turning ahead to 2025, manufacturers are very optimistic for the coming year. Last year at this time, they were mildly optimistic. This year, they're very optimistic for a rebound in 2025. We also asked a couple of special questions, one on the impact of interest rates and one on automation. We're seeing kind of a mixed picture with regard to investment in automation. So with that, that's kind of what I'll be getting into before we, as I said, before we turn it over to our Q&A portion. So keep those questions in mind and go ahead and do submit them using the Q&A feature in the Zoom or the chat so that we can answer your questions. So first, a few details about the manufacturing sector. When you look at the states in the Ninth Federal Reserve District as a whole, manufacturing is actually a relatively larger share of our economy here than it is the US. So you can see I've just kind of broken out GDP in 2023. That's the most recent full year for which we have data because, of course, 2024 just ended. So industry GDP in 2023, just comparing the US and the Ninth District. And you can see that nationally, manufacturing industries made up about 10% of GDP. And the Ninth District states, it actually made up 13%. So substantially more of our economy in manufacturing. And that's particularly true in Minnesota and the district portions of Wisconsin and South Dakota as well. But it's really evenly spread throughout our district. One thing I found in the past in getting into some of the county level details, manufacturing is actually a larger share of the economy in most non-metropolitan or rural counties than it is in urban counties. So manufacturing isn't just a big city thing. It's kind of spread out around the geography of our region. And it's especially important in rural areas. So that's just a look at what we produce in terms of the value of goods and services, and goods in this case being produced by manufacturing. In terms of the share of employment, it's also quite a bit larger in the Ninth District than it is in the U.S. So nationally, about 8% of a total workforce is employed in manufacturing in some capacity or another. And in the district, it's 12%. So you can see this is nearly 50% larger share. It's kind of weird to take a percentage of a percentage, but you can see quite a bit larger share of employment in our region. And again, if you get into some of the state level detail, you'll see that it's even more important. Minnesota has a larger share of manufacturing than the U.S. As well. So that's just kind of to level set manufacturing, even though it's been sort of declining as a share of output and employment in the U.S. over the last 50 years. It's still a very important part of our economy. Still accounts for a lot of economic activity and employment. So to get into the survey results, like I said, basically, quick summary, 2024 was another down year, positive expectations for 2025. little bit of detail about this survey before I get into the nitty-gritty of the survey results themselves. So one thing I'll say is this is among the many surveys that we do, and if you watch our regional economic conditions webinars, you're familiar with them. This is one of the more sort of cost-intensive and also sort of scientifically rigorous surveys that we do. It's based on a random sample of manufacturers. The poll it's conducted via mail from a mailing list. We stratify that sample by state and firm size. So there are relatively more manufacturers in Minnesota than there are in the other states in our region. So we're sampling more from Minnesota. It's also sampled by firm size as well. So most manufacturing firms are pretty small, and so we're taking a good share of the small firms. We're making sure that we're getting all the largest firms too. So the larger the firms get, the more of a share that we're sampling. That's just kind of a quick detail about who exactly it is that's responding to this. And we had a really good turnout this year, 487 respondents out of the approximately 2,500 that we surveyed around the region. And I would be remiss if I didn't mention that this survey is conducted in partnership with the Minnesota Department of Employment and Economic Development. Minnesota DEED conducts the Minnesota portion of this survey, and they'll be releasing their results today just for Minnesota. So if you're interested, you can check out their website. We'll also be publishing our article today on our website, minneapolisfed.org. That should go up later this morning if you want to read more detail about these results. So just another quick breakdown of who it is that's responding to this survey. You can see this is the distribution of responses by state in our region. I skipped over, oftentimes I cover what exactly the Ninth Federal Reserve District is in these webinars. You can see the states actually listed in this pie chart. We don't cover all of Michigan and Wisconsin. We have the Upper Peninsula of Michigan. It's part of the reason why that's a relatively small share, obviously. Manufacturing is a very important part of the Michigan economy overall as a state, but the UP is a relatively small population share of Michigan. It's a small GDP output share of Michigan as well, and so that's why we have a relatively smaller share there. Pretty good turnout from Wisconsin, though, because even in the northwest portion of Wisconsin, which is more heavily rural than the eastern part around Milwaukee and Chicago and Madison, which is not in our district, we still have a lot of manufacturing in our region in places like Eau Claire and La Crosse and Chippewa Falls and other parts of Wisconsin that are in our district. And as you can see, the lion's share of the respondents are from Minnesota, again, because that's where the bulk of the manufacturing firms in our region are from. So thanks to DEED for conducting the Minnesota portion of the survey. We conduct at the Minneapolis Fed the other portion, and all the results I'll be showing you are for the district as a whole. So overall, this is kind of this sort of overall takeaway of what happened in 2024. I'm showing you what's called a diffusion index here. So for all of these questions, we ask the businesses whether they saw activity increase, decrease, or stay the same over the last year. And anything with a value higher than 50 indicates that on average, these businesses told us that indicator increased. Anything below 50 indicates that on balance, they told us it decreased. And as you can see, most of the indicators in this chart are below 50. The most noteworthy one of all is orders or sales. That's really your sales revenue. That was down quite a bit year over year, but also production and employment. And really across the board, labor availability has tended to be down the last few years, but it's actually a smaller portion of respondents telling us that labor availability got worse over this past year, kind of an indication that the labor market has maybe softened a bit. Investment coming in just slightly positive, just above 50, you can barely see it. And productivity actually increased as well. So to put just kind of a few more numbers on this, just over half of the manufacturers that we surveyed this last year told us that their orders were down in the last year. So a slight majority actually saw a decrease in orders, which is a pretty large portion given how these go. And only a quarter of them told us that their orders increased over the last year. And again, if you're interested, you'll be able to see a more detailed breakdown of these responses and these results with the table that'll run with the article later this morning on our website. Just to kind of put these in historical context, I mentioned this is actually the second year in a row now we've seen manufacturers in our region tell us that manufacturing decreased. So you can see where we kind of compare. And here I'm showing you just orders, production, and employment, kind of these three sort of, I think, core metrics for the industry. All three were down year over year in 2024, and they were down in 2023 as well. This is once again, by the way, a diffusion index. So falling below that bold black line in this chart indicates that it was in contractionary territory, second year in a row in contractionary territory. And falling further means we had a larger share of respondents telling us that these were down on balance. So 2 years in a row of relatively weaker manufacturing activity after coming off of a few strong years following the pandemic. Obviously, 2020 was a down year for most of the economy, and particularly for manufacturers that had to shut down a lot of their operations. Saw a really strong rebound in 2021 and 2022. The biggest concern we were hearing at that time was about finding adequate supply of workers. So to have employment down in year-over-year terms is pretty substantial, pretty big turnaround from a couple of years ago. And this is in contrast to the overall economy, where we saw growth through 2024 in GDP, both nationally and from what we can tell from the data available so far in our states in the district. So having said all of that relatively unpleasant news about 2024, the positive thing that we can say based on the survey results is that expectations for 2025 are very bullish. So what I'm showing you here is what I've just showed you before in the teal. That's what they told us happened in 2024. And now I'm adding on their expectations for all of these indicators in the year to come. So on the survey, we ask what happened to all of these over the past year, and what do you think is going to happen? What do you expect is going to happen for your firm in the year ahead? And you can see big growth expected in the number of orders. In fact, almost the reverse of the pattern that we saw for the backward-looking indicator. Nearly 50%, just 49% of respondents told us that they expect their number of orders, their demand, to increase in 2025 relative to this past year. But that's true across the board for the other indicators as well. The one exception being labor availability, but you can see that is actually nudging close to growth neutral on this index. Slight positive expectations for exports. You can kind of almost put that in the flat or unchanged bucket on balance, but that is in slightly positive territory. But the rest of them are solidly in positive territory, including capital expenditures, including profits. And I should note also selling prices, the prices that manufacturers were charging to customers, they went up quite a bit last year, and they're expecting them to continue increasing this year. So not necessarily a great sign for inflation. At least that's the perspective of these manufacturers. So again, to kind of contrast that with the last couple of years, you do see a notable bounce in expectations relative to a year ago. In fact, we've kind of got the strongest level of optimism in the last 3 years. And so what I'm showing you here in this chart is just what we got on an annual basis for year ahead expectations going back to 2025. So we've been doing this survey 20 years now. And I'm sorry, 2005. I think I may have said 2025 is the beginning of this series. You can see they tend to be optimistic. And even last year, they were optimistic for 2024. On balance, they were mildly positive for the year to come. In retrospect, it ended up that they told us that conditions worsened over the past year, but they're pretty strongly positive for the year to come. So expectations are, historically speaking, coming in pretty solid level. Compared to where they've tended to be in the past. So that's a good sign. And it's not just actually for their own businesses, but they're also expecting some growth in their state economies as well. Now I'm going to turn it over before I get into the Q&A portion. I'll just present the results of a couple of quick special questions that we asked on our survey. One about automation and one about capital market conditions and interest rates. So we were interested, and we've asked questions like this in the past, given the number of reports that we tend to get from manufacturers about how difficult it is to secure adequate labor, are they making more investments in automation? And maybe somewhat surprisingly, just over half of the respondents told us that that they actually did not increase their investments in automation in the past year. So 52% actually told us that they didn't change or increase their investments in automation. I will point out, though, that among those who did, the most common responses were that they were making those investments to either increase productivity or to reduce their challenges with labor, either to mitigate the labor shortages that they're experiencing or to reduce the cost of labor. So that tends to be a pretty strong consideration. You can see some of the other responses here, but overall, maybe somewhat surprising in that we're seeing most of this, a slight majority of manufacturers telling us that they're not seeing any increase in automation. I'm happy to talk more about that if there are questions. Before I turn it over to the Q&A portion, I just kind of want to review the results of a question that we've been asking for a few years about the impact of interest rates. Obviously, we've been in a changing monetary policy environment. Interest rates increased over the last couple of years. The Federal Open Market Committee started reducing interest rates late in 2024. So we're interested in asking how they expect the change in interest rates to affect their business over the coming year. And as you can see, if you read this chart, overwhelmingly, they're not expecting much change due to interest rates. Most of them are saying that they expect pricing, inventories, savings, hiring, and capital investment all to be the same, at least as far as the impact of interest rates goes over the coming year. A larger share in most cases expecting that interest rates are going to have a downward effect on these. But again, most of the bulk of the respondents telling us that they don't expect any effect from interest rates. Interestingly, slightly more than a third told us that they expect the current interest rates to increase their pricing to customers. Now, with all of these questions, we don't really know why they responded the way that they responded. It could be that they're thinking, well, their cost of financing is higher, and they're going to have to pass those costs on to customers. So it's interesting to see that result. But again, even in that case, the majority of respondents told us that they're not seeing any impact of the current interest rate environment affecting their operations for 2025. So with that, I'm going to stop sharing my screen in a moment after I just share my contact information with you, in case you want to reach out to me if you don't get a chance to ask a question, or I don't get a chance to answer it before we're done here this morning. And with that, I will stop sharing my screen and see what questions have shown up in the chat from Haley.
Yeah, so Joe has some time for questions. If you have questions, please type them in the chat box on Zoom. How about we start with this one? With manufacturers so optimistic for this year, does that mean they're not concerned about the impact of potential tariffs?
Yeah, that's I think probably the big question that's on everyone's mind, especially maybe after seeing these results. I have a lot to say, I guess, in response to that. But first, a few caveats. The one thing that I want to point out, and I should have mentioned this in my presentation, this survey was conducted after the November election. We tend to do this in election years. We wait until after the election, so there's a little more certainty about what the administration is going to be going forward. So we conducted the survey after the election, but we actually designed the survey form, and I mentioned it's conducted by mail, so it takes a little time to develop. We actually came up with the questions and designed the survey prior to the election. So we didn't really think, we didn't know at that time it would be super relevant to ask a question about tariff impacts. That's obviously going to be something that we will pay attention to going forward. But I do think that there is some information that can be gleaned from this. Again, one more caveat that I'll offer is we don't know why any of these manufacturers are responding in the way that they do. It's just a two-page paper form. They give you a multiple choice response. They do have the opportunity to comment, but we can't really unpack the black box of sort of what's going on in their heads and why they respond the way that they do. So it is noteworthy that there's a lot of talk about tariffs. We know that those had a big impact on manufacturers back in 2017, 2018. That they're pretty bullish given that. One way of reading that might be their expectations for the coming year are strong enough that that kind of washes out whatever negative impact of tariffs there might be. Another important bit of context to provide on it, though, is as I mentioned earlier, most of the respondents in this survey are fairly small manufacturers. And in fact, a lot of them don't do international business. So we ask among all of the survey indicators that we ask about, one of them is exports. And that is the one that is most likely to be not checked by the respondents. They're most likely to leave that one blank because a lot of them don't do any exporting. So for those, for small manufacturers that have, 2, 3, 5 employees that are just doing business in their local communities, maybe they're not expecting this to affect them that much because they're small, because they're not exposed to international issues as much. Obviously, we know that the larger manufacturers in our district are global in scale, and they expect these, they're going to expect maybe some disruptions in their supply chains and things of that nature. The other thing I'll point out is we did get a number of comments about this on the survey form, and they were, and I don't want to exaggerate the number of comments that we got, but we did get a few comments from contacts saying that they're very concerned about tariffs. And so a few examples. One person mentioned that they were concerned about how tariffs were going to affect their pricing for aluminum, for example. Another person mentioned that the last time we saw this sort of flare up in trade tensions, that it was bad for their business, and they're sort of expecting that to be the case again. So there's a number of comments that we got sort of unsolicited about the impact of tariffs. So we know that a lot of these manufacturers are concerned about it. But again, if you just look at the headline results without knowing exactly why they answered what they answered, they are still on balance optimistic for the coming year.
Thanks, Joe. On a similar note, someone was wondering, who are Minnesota's largest trading partners and which states would be the most impacted?
So I can't tell you which states would be the most impacted. Our largest trading partner in Minnesota is Canada, and obviously there's, one major reason for that is just proximity. Canada's right next door, and that's true about most of the northern states. And then as you might expect, Mexico and China are right up there as well. So those are really the largest trading partners for most states in the country, and for most of the states in the region. Also, you'll find there's been an increase in trade over the last decade with Southeast Asia, in particular Vietnam, among manufacturers in our region. I think that's more concentrated on the agricultural side, though. There's been an increase in agricultural exports to Southeast Asia from agricultural producers. I don't know. I did hear anecdotally from a lot of manufacturers in we'll say 2017, 2018 that they had to sort of adapt their supply chains and find more suppliers in countries outside of China. And so I think that that's had an effect. And in some ways, maybe a lot of those manufacturers who made those changes, those decisions in the past, are a little better positioned to weather. But again, it's also worth pointing out that all of these policies are still sort of hypothetical at this point. It's more, and I think that's also behind kind of what we're seeing in terms of some of the optimism, what they know about the economy and what they expect to happen, versus the sort of hypothetical threat of a trade war. On balance, it's washing out toward the optimistic side.
Thanks. Kind of switching gears here, someone was wondering, why do you think that there is such low investment in automation right now?
So that's a good question. I mean, I think, again, once again, the caveat applies that we don't know why they responded, how they responded. We didn't get a lot of comments with regard to that particular question. I think there's two big countervailing factors over the last year with regard to investment in automation. One is the labor market has softened a bit, and we know that from the macroeconomic data. Even though unemployment remains low, we know that hiring activity is down, and you can see that in the results of our survey as well. They told us that their hiring and their overall employment levels were down over the last year. So I think some of those labor supply pressures are maybe a little less acute for them over the last year. And then the other thing, of course, is that even though interest rates have come down slightly over the last few months, overall they're higher than they were a few years ago, and so the cost of financing capital expenditure is higher. Now, interestingly, we did see slight positive growth in capital expenditure over the last year. Like I said, it was almost flat, but apparently a lot of that is not necessarily in automation. It's maybe in purchasing other kinds of machinery or plant or property.
And someone asked, did you hear anything about, like from your respondents about AI usage or the impact of AI?
So that's a good one. We actually asked about AI on last year's survey because it was a sort of a popular topic. There was a lot of talk about it, and we know that among all of the different sort of industry sectors, manufacturing might be one of the most heavily impacted by AI. Um, uh, more maybe on the logistics and the supplying side, but also in the on the automation side as well. And really, we didn't get a lot of. It was sort of like the automation question this year, only even more so, where bulk of respondents last year told us no, we're not really doing any investing in AI. A few of them told us that they were, and even that they were investing a lot into it for various reasons. So one of the questions we asked about automation actually was, was whether they were investing in automation to take advantage of AI, and that was actually the smallest response rate, and it was only a few percentage points told us that they were making investments in automation related to AI. So overall, it seems like there's a lot of talk about that, and some manufacturers are really going heavily into investments in that area. But overall, it seems, again, maybe owing to the typical size of the business responding to this survey, they just don't necessarily think it applies to them.
Great. And it looks like that's all we have time for today. So thank you everyone so much for joining us. More information will be in our follow-up email to this event. And please join us for our next virtual event, Regional Economic Conditions, General Business on Tuesday, February 25th. And with that, I hope everyone has a great rest of your day.